Hi there, this is Joel from Crossport. Most property investors do not do enough number crunching before selecting a property, and they rather rely on a rough mental calculation. They hope to achieve good results without factoring in everything that dictates the outcome. If you're one among them, this video is going to be beneficial, as I will show you how to systematically research the property you are interested in. The following are the key learning outcomes. Understand all the costs associated with the property purchase. What happens when interest rate changes? How will this property purchase affect your personal cash flow? And how much money will you finally make after selling the property and paying taxes at the end of your desired holding period? As the purpose of this exercise is to ensure that the property under consideration is feasible for your circumstances and you can really afford to hold it for your desired holding period, we don't want to be too optimistic when putting in the numbers. The idea here is not to make a property look more appealing than it is, but to expose the reality. I recommend you complete this workbook before every property purchase to know what you're really getting into and how it will align with your strategic investment goals. Essentially, this will help to eliminate the guesswork with which most investors unfortunately operate. Keeping this in mind, let's get started.
The workbook is color-coded, and you need to enter values only for the cells highlighted in blue. Others are automatically calculated for you. I've provided a brief explanation for each field to make things easier for you. You should start by providing the address of the property and the anticipated purchase price. If the purchase price is unclear, you can put in the maximum price you will likely offer for this property. In this example, I've provided it as $400,000. The following section deals with the acquisition cost. And the first one here is the deposit amount you are contributing from your pocket for this purchase. Let it be $48,000. Thus, the loan to value ratio is automatically calculated as 88%. Having the LVR at 88% is a sweet spot, as the amount of lender's mortgage insurance premium you must pay increases significantly beyond this LVR. A good mortgage broker will be able to guide you further on this. Now, we've got the stamp duty. They vary based on the purchase price and the state in which the property is located. I've provided a link to an online calculator here to help you find the stamp duty payable. Another expense is for conveyancing. I've kept $2,000 for the conveyancing fee, as it's essential to have a good conveyancer who is very prompt and diligent. The next one is building and pest inspection fees. I do not recommend buying a property without a proper building and pest inspection, regardless of the property's age. I've accounted for $600 here. Electrical and plumbing safety inspection is generally not taken for properties under 20 years old. Still, if you're worried about it, you can enter an approximate figure for the electrician and plumber combined. A rough estimate would be to consider $600 each. The next one is for people who plan to use a buyer's agent to purchase the property and leave it as blank if you're doing everything by yourself. The last one in this category is the cost of setting up the purchasing entity. Suppose you're buying the property under personal name. In that case, this is not applicable. But if the purchase is under trust, partnership, company, or SMS of entities, there will be an additional cost here. You must speak to your accountant or engage a licensed financial advisor to determine the proper structure based on your needs. Once you fill in all of these, The total acquisition cost for the property is calculated here for you. Now, let's put in some numbers related to the cost of financing. You should get the correct figures from your mortgage broker, but as a rough estimate, I've considered $10,000 as the lender's mortgage insurance premium. This insurance fee is payable when the deposit is less than 20% of the purchase price, and it is there to protect the lender and not you. But some occupations like doctors, nurses, accountants, IT professionals, etc. qualify for an exemption from specific lenders. So please double check with the mortgage broker whether you are eligible. If you qualify, it can save you a lot of money. The following field is the total loan amount. The minimum amount to fill in here is the purchase price minus the deposit plus the lender's mortgage insurance premium. In this example, it becomes 400 minus 48 plus 10, which is $362,000. But depending upon the lender, there can be other closing costs for the loan. If applicable, you should include them as well. If you are using equity from an existing property to buy this investment property and plan to pay all acquisition costs from a separate equity release, then your total loan balance will be higher than the purchase price. If that's the case, you can enter the total loan here and leave other cells in the acquisition cost section blank. But please remember, if your total loan is more than 100% of purchase price, then your cash flow will not be great unless the rental yield is really high. Now, you can go ahead and enter the loan period here and the interest rate of the loan in this cell. Please note that for all calculations in this workbook, we consider only the interest portion of the loan and not the principal, as the interest component is the actual cost of doing business. By paying principal, you are in fact slowly building equity. But all the feasibility checks we undertake are based on market growth driving the equity uplift and not by loan pay down. With this information, you can see that the system has generated the total interest payable for this loan on a yearly basis. At a 5% interest rate, you can see that the interest payable each year is just over $18,000. Now let's find out whether paying this much interest for this property is something you can afford comfortably. We do not want to assume anything here, so let's fill in more information and find out. Here, you need to enter the expected weekly rental amount for the property. You can ask the selling agent or an independent property manager to provide a rental appraisal. Be conservative and take the low end of their range and input here. I've taken a rough weekly rental of $600 and you can see the total annual income calculated as $30,000. Please note that every rental property will experience some vacancy period in the long run. And just because the rental market is very tight now, we can't just assume that will be the case always. So, for a property that is situated in a well-selected suburb, it shouldn't be vacant for more than 2 weeks a year on average. And hence, the annual rental income calculated is for 50 weeks instead of 52. Unfortunately, every business has operating costs and investment property is no exception. We need to account for all these items when analyzing a potential deal. Knowing what you are really getting is the bare minimum you can do before handing over your hard-earned money for something. The first one here is the property management fees. In certain states like Victoria, this fee is relatively low and you can find a good agent for under 6%. However, the average is around 9% in other states like Western Australia. In this illustration, I've assumed this fee as 8%, as you should be ready to invest in locations where the growth prospects are high and be a borderless investor. In addition to a monthly management fee, the property managers charge for other things such as leasing, advertising, admin, etc. Most of them are negotiable, and you can confidently assume the figures which are put in here as a rough guide. The next one is the insurance cost, and I do not recommend you assume and put any random figure here, as depending upon the area, the insurance premiums can be very high. Almost all insurance providers have the option to calculate premium online, and please make use of it before signing a purchase contract to avoid surprises later. Please take multiple quotes to understand if there is a likely chance for the low premiums from one provider to increase in the future. Insurance is there to protect you as an investor if things go wrong. The last thing you want is an insurance refusal or lack of desired coverage when things go against you. The idea here is not to purchase the cheapest insurance option, but to get one from a reliable provider. Next is the rates section. You should ask for all fixed outgoings from the selling agent. Council rates in some regional areas are much higher than properties in metro areas. Putting an average amount here is not a great idea, as it can vary significantly. A body corporate fee is generally applicable for attached dwellings and apartments. If this applies to your case, please fill it out as well. In certain states, the council rates include water, while in others it is kept separate. So please check this clearly with the selling agent, as we do not want to do double dipping. If water rates are separate, please enter it here. Otherwise, leave it blank. If you hold land with a value above a certain threshold of the state where you plan to buy the property, then you may be liable for land tax. You can search online for various thresholds, and please fill this out if applicable. Please note, this is not based on the market value of the entire property you have, but on the value of the land component excluding buildings, and each state has its own calculations. Now, we need to account for general repairs and maintenance of the investment property. For a carefully selected investment property of fewer than 30 years old, we can assume an average figure of $1,500 annually. If the property is old and unrenovated, this will increase. Next is the fee to do annual compliance checks on the property, such as smoke alarms, gas and electrical safety checks, etc. Every state has different rules, and moving forward, this will only increase. So please account for at least $300 for this one. And the final one here is the accountant fees. If the property is purchased under a different entity such as trust, this fee can be significantly higher than what is shown here. So please enter according to your personal circumstance. Now, the system will automatically calculate the total operating expenses for the year as well. In our current example, it's $10,700. Your total expense related to this property every year is the sum of interest cost and operating expenses. That is, the sum of this cell here and this one. You don't need to do this calculation manually, as the tool will do it for you. And as you can see, the system has calculated it as $28,800, This is the amount of money you will pay for various expenses if you become the landlord of this property. But don't stress about this figure too much right now. We need to account for the incoming rent from this property as well to get a better idea of our financial position due to this purchase. So now, let's look at the cash flow projection. The green color for this cell indicates that the cash flow is positive, and red indicates negative cash flow. This cell demonstrates that with a $600 per week rental income and an interest rate of 5%, this property will not cost you anything to hold and generate $1,200 yearly as positive cash flow. If the cash flow is positive, then you need to pay tax for this based on your marginal tax rate. And if the cash flow is negative, you will get a tax refund as long as negative gearing is allowed. Even though having an additional $1,200 a year from this property will not change your life dramatically, it is always important to consider the cash flow position. The reason I say this is, if you take on loans that are heavily negatively geared, it may affect your ability to borrow again and restrict you from building a big enough portfolio. Also, please note that we haven't included the tax or depreciation here for simplicity. Let's look into this section. And this is where things gets interesting. You may have noticed that there are 4 cells such as interest rate, weekly rent, annual growth percentage, and holding term, which are highlighted in black. These are the anchor cells with which you can model and personalize this workbook. What I mean by that is, do you want to see how your cash flow projections change when the interest rate increases to 8%? In that case, all you have to do is come to this interest rate cell and change the value in this cell from 5% to 8%. Suddenly, you have a negative cash flow of over $9,000 every year from this property. This way, you can stress test and ensure that even when the interest rate increases, the property you're buying today is something you can afford. Some people can afford to lose $9,660 yearly in cash flow, but that may be different for others on a tight family budget. Depending upon your income and risk tolerance, you should stress test with an interest rate higher than the current one to accommodate future rate rises. The last thing we need as investors is to sell the property forcefully when the market is not suited for it. Similarly, you can reduce or increase the weekly rent and see how this will affect your cash flow. By varying these 2 levers, you can replicate the likely market fluctuations that may affect the ability to hold the property comfortably over the long term. Again, please remember that this out-of-pocket contribution is based on interest-only repayments. And if you opt for principal and interest repayment type, this will increase substantially. This is one of the reasons why investors generally try to keep their loans as interest only during the accumulation phase of property portfolio building. Now we are in the last and most important section, which deals with the growth projections. The first 2 cells, since they are highlighted in black, are anchor cells or levers. You can change the values of these cells and see what impact it has on the property under consideration. First, let me explain what each of these different cells denote. Annual growth percentage is the expected capital growth in percentage for the property on a yearly basis. Maximizing this factor should be the primary focus for investors, and this factor alone will determine your success, as long as you can afford to hold the property. The Australian long-term average for capital growth is 7%, and for simplicity, I've taken that figure here. But with GrowthSpot, you can outperform the Australian average. This doesn't mean by using services from GrowthSpot, you are going to make 8% growth year on year every year. All it means is if the Australian average for the next 10 years is 3%, we will beat it. If the average growth for the next 10 years is negative 5%, with GrowthSpot, you won't lose that much. I hope you are getting the concept here clearly. The holding term or maturity year is the period till when you plan to keep the property. If you plan to hold this property forever, please enter a hypothetical figure. Let's assume you will have this property for 20 years before selling. Based on these two inputs for growth percentage and holding term, all the other growth projections are automatically calculated for you. You can find the total interest payable to the bank during this holding period here in this cell, and the net rent collected from tenants here. As we all know, rents will increase over time, but to make our calculations simple and conservative, I haven't accounted for such an increase. The important cell to note here is the property's value at the end of the holding term. As you can see, this property will be worth over $1.5 million in 20 years. But all of it is not wealth generated, as you have an outstanding loan plus your initial deposit in this figure. So the next cell here is before sale gross wealth generated. It shows the amount of wealth you have actually developed from this property by holding it for 20 years as per this example. Again, this wealth is currently only on paper, and this is not realized profit as we haven't yet sold the property. After you sell and pay taxes, what's left is the pure profit from the deal. In order to realize the profit, we need to account for some additional factors. First, let's consider the selling agent fee here. This fee varies from agent to agent, but as serious investors, we should be able to negotiate everything. So I've assumed it as 1.8% of the property's value here in this cell. Including the selling agent's commission in our calculation will give us a gross profit of over $1.1 million before paying any capital gains tax. As this is an investment property, we do not get an exemption. So we need to account for capital gains tax as well in our calculations. The rate at which you pay capital gains tax depends on your marginal tax rate. I have defaulted it to the highest marginal tax rate here, and you may not be on the highest one just yet. But please remember one thing. Even if you are on a lower tax bracket based on your income in 20 years, when you add the profit from the sale of the property on top of your regular income, most people will pay capital gains tax on the highest marginal tax rate. Now, what's remaining here in this cell? After tax net wealth generated is your net profit from this deal when you sell the property on the maturity year. If you want to see how much this deal will make after 10 years, you must come to this anchor cell and change the number of years value from 20 to 10. As you can see, the profit reduced drastically from $850,000 when your holding term was 20 years to just $270,000 when you reduce your holding period by half. This is due to the power of compound growth. The longer you hold, the better will be the overall returns. So, if the property you purchase grows faster in the short term, it will tremendously help compound growth. Unfortunately, this is not something every investor takes seriously, and they only look at the very long term. Investors must pay more attention to understand this concept to take advantage of huge gains. In a similar fashion, you can reduce the annual growth percentage from 7% to 6% and see how much the reduction in net worth is at the end of the same holding period. As you can see, the net wealth generated has dropped significantly. This is the exact reason why every property investor must find and invest in locations with maximum growth potential, as even a tiny 1% change to growth equates to hundreds of thousands of dollars over your holding period. Since more than 80% of growth of a property is determined by the suburb itself, it is very critical to get this part right. Now that you're familiar with this workbook and how to use it, let me remind you one thing again here. The purpose of this workbook is not to help you select properties based on these numbers, but to check the numbers of the properties you have already shortlisted based on various short-term and long-term data factors. So please do not take any random property from realestate.com or domain and check the feasibility with an intention to purchase. Of course, you can do it for practice, and if you have an investment property already, you can plug in those numbers and have a trial go at it. But only once you have identified the best suburb to invest in and the best pockets within that suburb, you should start to look at properties that fall into such locations. It is at that stage you should do the feasibility at the property level, where this property feasibility toolkit becomes handy. I've provided the link to my website in the description, and you can get a copy of this tool from there. When you download the sheet and start using it, you can leave this tab as it is for reference and use the new sheet provider here for your research. It has the exact same details, but with options to compare up to 5 properties. As I often find that investors have more than one property even during the final stages of shortlisting. If you find this information useful, please like the video and share it with someone who may find it helpful. If you have any questions, please let me know via comments, and for more property investment and strategy workbooks, please leave a comment as interested. Thank you and bye for now.